Leopold Aschenbrenner, a 24-year-old former OpenAI researcher, has some of the world's most historical gains, building a hedge fund, Situational Awareness, from 225 million to somewhere north of 20 billion in under 2 years. He's up 439% just on the year alone, and Silicon Valley calls him a prophet. Then, in the space of about a week, he loses more than half of it, forced to dump his entire public stock portfolio to Griffin Citadel, and what's being called one of the largest emergency stock transfers on Wall Street in years. This isn't hypothetical. This happened in the last 2 weeks, and well, you can see the returns already. And the reason it happened isn't some mystery. Leopold isn't a typical hedge fund manager. He's a German-born, graduated valedictorian from Columbia at 19. He joined OpenAI's super alignment team in 2023. The team focused on making sure advanced AI stays safe. He was dismissed from OpenAI in 2024 over what the company described as an improper disclosure of internal information. A few months later, he published a 165-page essay called Situational Awareness. Well, this is the name of his hedge fund. The thesis was, well, AI progress was accelerating too fast, faster than anyone can understand, and it will require a massive real-world build-out, chips, data centers, memory, power generation to support it. He didn't just write the essay, he put his money where his mouth was. He launched a hedge fund named after the essay and structured the entire portfolio around that thesis. Along the physical infrastructure of AI, and in some cases, short software companies he believed were vulnerable to AI disruption. Early backers allegedly included Stripe co-founders Patrick and John Collison, along with tech investors such as Nat Freeman and Daniel Cross. That's a serious network of capital and credibility behind a manager with zero prior professional trading experience. Yeah, this guy's a prodigy. The fund launched in late 2024 with around 225 million in assets. By mid-2026, estimates put it anywhere between 20 billion and 45 billion, depending on the source and the exact date. The portfolio was concentrated in the picks and shovels of the AI boom. Now, here's the part that matters the most. The fund was running leverage of roughly 4x, sometimes reported as high as 400%. That means for every dollar of investor capital, the fund was controlling roughly $4 of market exposure, using borrowed money from its prime brokers to do it. In mid-July 2026, the AI trade started to reverse. Semiconductor and AI infrastructure names, the fund's core long positions, began falling sharply, some down 30 to 50% in a matter of weeks. At the same time, the software short positions moved against the fund too, rising instead of falling. On July 24th, Leopold sent investors a letter acknowledging the fund had taken heavy losses, but according to reporting, he framed the sell-off as a buying opportunity. However, human nature here is critical. Once losses start and leverage is high, the word gets out. Other funds and traders can see the position data and start trading against a known vulnerability. Over the following days, prime brokers such as Bank of America, Goldman Sachs, JP Morgan began issuing margin calls. When your leverage 4x and your collateral value drops, brokers demand more capital or they force liquidation to protect their own exposure. The fund didn't have enough cash to meet the calls. So, on a single trading day, Situational Awareness sold essentially its entire public equity portfolio to one buyer, Citadel, the hedge fund run by Griffin. The deal was reportedly done at a discount, and it completed in under 24 hours, described by some outlets as one of the largest emergency stock transfers on Wall Street in recent history. The fund assets fell from a reported peak of around 45 billion to roughly 10 billion. You see, Leopold may end up being right about everything. A fund with no leverage could have ridden out a 30-40% drawdown and waited for recovery. A fund at 4x leverage just doesn't get that chance. In fact, once the liquidation was complete, some of the very stocks that had cratered bounced 15 to 25% within days. Look at MBIS, SNDK. That's a pattern worth remembering. It's almost as if they crashed the market just so they can buy his portfolio. Hey, that's just a theory. Now, this event was very short-lived as all the stocks currently, as of this date of recording, are up. What's not in the question is the mechanism that got us here. Leverage, concentration, and a thesis that didn't leave room for being wrong in the short term. Well, it paid off. If you find this breakdown useful, please hit subscribe. I'll be tracking how this plays out and whether other leverage players in the AI trade are facing similar pressure.